This is the first lesson of Chapter 7, which is on finance. Finance is a new topic in the grade 9 curriculum, but it's really important to learn because it's directly applicable to your everyday life. So some of the things you learn in this chapter, you'll use in your high school life, but more importantly, you'll take them forward with you as you become adult, and hopefully these things will help you become a financially responsible and well-informed adult. Our world revolves around the economy, different currencies, investments, buying houses, different products that you purchase and sell, and your jobs, etc. So these topics are quite important. The first lesson is on income, banks, and budgeting. So some different income terminology. Income is money received in exchange for providing a good or a service. So most of the time, income is the salary or the money that you get from your job. There's gross income and net income. Gross income is a person's salary before any deductions have been subtracted. And then the net income is what you actually take home. So this is a person's salary after deductions have been subtracted. So you might make $50,000 a year, and that's your gross income. But then you have a bunch of deductions that you have to pay. And after those are all paid, then what you actually take home is your net income. Some examples of common deductions that are on people's paychecks would be income tax. So that's a huge one. You pay tax on every dollar that you earn. So income tax gets deducted. Some other common ones would be the Canada Pension Plan. So a pension is something that you use when you get older, when you retire. And so most Canadians contribute to the CPP or the Canada Pension Plan, and a little bit of their paycheck goes towards that. There's also employment insurance or EI. You pay a little bit off each paycheck into this employment insurance. So if one day you lose your job or you're not employed, you can get some money to survive until you get back on your feet. Some jobs also have union dues. So as a teacher, I have union dues on my paychecks because I'm part of a union. And so a little bit of money each paycheck goes towards my union membership. We talked about salary briefly, but your salary is the amount of money that you're paid over a fixed period of time. Usually this is yearly. So again, maybe you make $50,000 a year or $100,000 a year. But you don't only make it at the start or the end of the year. It gets paid out on a consistent basis throughout the year. So you might get paid monthly, like maybe at the end of every month, maybe weekly. I think the most common ones are semi-monthly or bi-weekly. So semi-monthly is twice a month. That's what my paycheck is. So every 15th and 30th of the month, I get my paycheck. Some people also get bi-weekly, which would be every 2 weeks. So like, for example, every other Friday they get paid. Those are common examples. Overtime pay, sometimes you work overtime when you work additional hours to the regular working hours that you would have. And when you have overtime, you get paid extra for doing so because no one wants to work extra hours. Sometimes you also get overtime pay if you work on a day that other people don't want to work. So for example, on a holiday, if you're working on Boxing Day, December 26th, this is considered a holiday. And so often you get paid extra money, like time and a half or double time, because technically you should have had the day off. But let's say you work in retail and a bunch of people are going in for Boxing Day sales. They need people to be working, so they pay you extra because you have to work on a holiday. Or maybe you're working a job and normally you work 8 hours in the day, and for whatever reason, there's a really long project and you have to work 11 hours that day. So that extra bit over time, you get paid more for. So you might hear the phrases time and a half or double time. Time and a half means you get paid 1.5 times your regular wage, and double time means you get paid double what you would normally get paid. Looking at different wages. So a wage is how much money you make per hour. Typically, if you're working a full-time job, in 1 week, you work 35 to 40 hours, somewhere around there. And a typical working day would be 7 to 10 hours, usually more like 8. So the pay that you would get each day is whatever your wage is multiplied by how many hours you've worked. So maybe you make $20 an hour, you worked an 8-hour day, you get 20 times 8 total dollars. We already talked about gross pay. So gross pay is how much money you make before deductions. So this would be whatever your regular pay is Plus, if you've worked any overtime, you also get that pay as well. Different types of banks. So these are important to understand because this is where your money is going to be. And banks also offer lots of other services. So a bank is a place to invest or borrow money. So you can essentially give them money, or they can take your money. You open bank accounts to store your money. You might have a checkings account or a savings account, which we'll talk about more later. Or at different banks, you might open investments because you want to earn extra money. Sometimes you might need to take out a loan. Maybe you need a student loan or you need a loan for your car. So you can do this at a bank as well. And banks also allow you to exchange money to different currencies. I have some icons here of the most common banks in Canada. So some examples: BMO, like Bank of Montreal, RBC, CIBC, TD, lots of acronyms here, Scotiabank. There's also Van City, Tangerine, HSBC, lots of different big banks. Checkings versus savings accounts. Most adults have both of these accounts with their bank. A checkings account would be the account that you're frequently using for common expenses. So there's often money going in and out. And it's called a checkings account because you can write checks from them. These days, we don't really use checks that often, but if you did need a check, you would have to write it from your checkings account. And there is no interest earned on the money that's in here. It just sits in there and then you can use it for buying things. The savings account, on the other hand, you try to save your money by putting it in that account and not using it to buy things with. So you try to keep your money in there. You don't write checks, you can't write checks from it, so money does not leave it unless you specifically transfer it out. And you do earn a small bit of interest on it. So if you can manage to put some money away in that savings account, you will earn some extra money on the bit that is staying in there. Speaking of investments, generally the word investment means you're putting something in now to earn something better later. When we're talking about financial investments, you're putting money in something now, and then you're going to earn a profit later. So for example, the savings account we just talked about, you put some money today in the savings account and you don't touch it, and then you earn a bit of interest on it so that you have more money later. Other common investments would be investing in the stock market or buying bonds. And then another type of investment would be purchasing an asset. So purchasing a house, for example, and then selling it, 20 years later, that value of the house will have increased, hopefully, by a lot. So you buy it for something, you wait a while, and you sell it for more later so you can make some money off of it. Credit and credit cards. So you might see your parents with credit cards, or maybe somehow you might have one already. But credit cards are basically just a small plastic card that you can tap to purchase things with, and you purchase items immediately with it, but you don't actually pay for them until later. It's very convenient. You don't have to carry cash around. You just tap it and you're done. But it's a little risky because you have to make sure you're paying your credit card on time, or you'll have to pay extra fees for not paying it on time. So credit is just another word for money that you use now, but you don't pay it off till later. It's almost like an IOU, but you better make sure you actually give it back before the deadline. So the most common credit card companies you may have heard of would be MasterCard or Visa, or maybe even American Express. Moving on to budgeting. What is a budget and why are they important? A budget is a plan that you make to estimate the expenses and income for a certain amount of time. So budgets are really helpful because it can help you save money. It can help you plan for a large future expense. So maybe when you go to university, you have to pay for it. So now you'll start a budget to say, okay, this is going to be really expensive. What do I have to do now to make sure I have enough money to pay for this? Or maybe it's not university, maybe it's a car, maybe it's concert tickets, whatever it is. You want to be organized and planning ahead. Budgets are also used by large companies, by the government, by movie productions. They'll say, we have this big project going on. We think it's going to cost this much. We think we're going to make this much money. How can we make sure that this works? Here's an example of a budget. So for this person, they have their total monthly income of $4,000, and then they've listed out all of their expenses in different categories. So how much is their rent going to be? How much is their cell phone and their internet and their food, their car payments, their gas, birthdays, all different categories here. And for each person, it might be slightly different. But the idea is they say, I think I'm going to make this much money. I think I'm going to spend this much money. Is this an appropriate plan? Will I be able to reach my goals with this plan that I have? If not, you have to reconsider some things and maybe find ways to make more money or spend less money. But it's mostly just a way to organize your income and expenses and make sure you're on the right track for whatever your goals are. So what goes into the budget? Well, income, we've already talked about that, any money you're receiving. So it could be from your job. Maybe you don't have a job yet though, so your income could also be money you get on your birthday or from holidays or an allowance. Any money that you're getting to keep, that would be income coming in. Then you also have to include your expenses or things that you're spending. These might be fixed expenses or variable expenses. A fixed expense is something that stays the same every single time you pay it. So like your rent might be the same every month. Hopefully your phone bill is the same amount every single month, or like Netflix, Spotify, $10 a month. It's always the same every time you pay it. Whereas a variable expense, this varies. So it's different every month. An example might be food or clothing. You don't know exactly how much you're going to spend on food every single month. So it's slightly different each time. And the last thing, the difference between needs and wants. So a need would be something that is necessary for survival: food, water, somewhere to live, clothing, not necessarily brand name clothing, healthcare. You need these things to survive. Whereas wants, these are extra things that are not necessary to survive, but they're often nice to have. So like the newest phone, going on vacation, Netflix, you don't need to have Netflix, eating dinner out versus eating dinner at home. So it's important to understand the difference for you, what is a need and what is a want, and then you can adjust your budget or your financial goals accordingly. So that's the first lesson of Chapter 7 about different incomes, how banks work, and how to budget.